What is going on, everybody? It is David Ramsden-Wood here with Mark Rossano, and it is your pregame show to get you ready for the deep dive on the energy and economy that Mark will be releasing later this week. Mark, how are you today?
Pretty good. You know, it's an interesting move. In the first pregame show, we had talked about, are we going to go to 55 or 51st on crude? And we got to our 55. So we're here. And now it's a matter of, what is going to happen going forward now that we see a lot of the Chinese data starting to slow. Things are starting to adjust a bit. And as we talked about, like the EIA data had some interesting characteristics that's going to make this one even more important.
Okay, so let's start this week with the oil and gas prices. Natural gas, in part because, as you know, you've been covered with 14 inches of snow in the last 48 hours in New York, and natural gas prices are very close to $3 an MCF, getting back to where they kind of were in October before we had the crash down to $2.50. What are you feeling about natural gas and inventories at this level? Are $3 sustainable, or is this just a head fake based on a snowstorm?
It's going to come down to, weather is obviously the biggest driver in the near term in terms of where some of this spot pricing is, but you have to look at the curve in general. Now, there's been a lot of talk and a lot of concern that we're going to start to see that 5-year, storage drop below that 5-year average. And it's very likely at this point that will come to pass. We have gotten a little bit colder. LNG flows continue to remain robust, just given, what's happening in Asia. Now, the weather in Asia has started to temper, same in Europe. So we'll start to see some normalization. But just as that is happening, and then, in honor of Groundhog Day, Punxsutawney saw his shadow. So we're going to have a few more weeks of winter. And then the running joke is that winter is just now starting. So when we look at the supply side, that is the bigger concern, because when we look at associated gas, we've had a lot of oil production come down from that 13.2 to our expected 10.9, which is going to take some gas out of the market, just as we see additional flows going into the export market.
So it sounds like you're feeling like $3 could kind of stay here for at least the short term based on all those factors. Is that correct?
Yeah, I think okay. Right at this point, we're going to see some support between that $2.90, $3. And then as, the weather subsides, all of a sudden people feel a little bit that warmth, then you'll see that drop down. But there is some support at this point, just because $2.50 just doesn't make a lot of sense for different people. And you're going to start to see that normalize over the longer term.
So oil hit your $55 target before it hit 50. Congratulations on that. Now, where do we go from here? I mean, we have OPEC meetings going on this week. We have what seems to be good compliance. There's questions about Iran. What are you thinking is going on in the oil market, and what data are you watching?
So we had the push that came to pass that we were looking at in terms of some of the physical pricing out of West Africa got really weak, but then we had some increases coming out of Europe, especially the North Sea. And then when we looked at euro pricing, you could see that there was demand out there within Asia. It's just where was it going to reside? And it really was driven by India at this point. China has seen a fairly big walk back in terms of the demand that they've seen in general. PMIs are starting to show that with some slowdowns in manufacturing. And what's more concerning about China is not just the PMI numbers, but it's what's embedded within that, and it's new orders and new export orders. And we've been very adamant that it was a supply side recovery in China, not a demand side, which just means that the consumer was still weak within China itself. And it was more along the lines of rejuicing the supply chain. We had inventories down around the world. You have a huge bottleneck at the coast. So now that we're starting to see a little bit more normalization, especially in the U.S., Europe is a different story. But now you're starting to see some of those orders get filled, some of the demand coming down. Guys are shifting away from China. Apple just moved more manufacturing into Vietnam and Korea. You had what was it? Volkswagen, Toyota had to slow down production due to shortages in semiconductors. Everyone's pushing on Taiwan semiconductors to increase. So we're starting to see these shifts, and it's going. And you look at the Taiwanese and the South Korean data, Vietnamese data. It's getting a little bit better, just as China's getting weaker. So you're starting to see those pivots, which is going to impact oil demand in China in general. So when we're looking at what is going to happen next, you have to figure out, okay, well, we're about 2 million barrels a day over where we should have been based on, the cheating that we've seen. That has to come to pass by April. Unlikely to do it, just given how Russia is unlikely to meet the demands of their cuts. And then that's going to start to eat into the confidence, I think, that's within OPEC, even as you have obviously Saudi taking 1 million barrels a day voluntarily off the market. But by doing that, you're also supporting the moves at this level, and that's just going to bring the U.S. back in droves.
So feeling like there might be weakness, which ties us to China. And last week when we talked, you had refreshed your numbers for the weekly show, and you said you felt more bearish after seeing the contraction in some of the data than you had in a very, very long time. Obviously, it's a week to pass, and I have said, you and I chatted, that you're typically 2 weeks ahead of everybody else. So that would mean by next Wednesday, everyone's going to see the data that you saw. I'm just curious, as it comes to China, we saw some weird moves where the PBOC seemed like they were tightening, and then they put in an injection of yuan into the repo market overnight over the last couple of days. What's going on in China right now that's causing such ebbs and flows of capital?
So right now they're trying to manage that rate. So when they took some liquidity out of the market, the SHIBOR exploded higher, and then all of a sudden you had this friction in the overnight market, and they wanted to lessen some of that because they came a little bit too much too fast type situation in terms of liquidity. So they started to buffer that, putting some additional liquidity back into the market to try to smooth things out. But even though we're seeing a bit more liquidity going in, those credit impulses are still coming down. We're still seeing some of that slowdown in manufacturing. And now there's a mixture of what is structural and then what is seasonal. Because right now on a seasonal level, you normally get a push of liquidity into the market as people take money out ahead of going on their vacation for Lunar New Year. So there's a mixture of, okay, well, they put some in because you had some rates going out of control, but you also are going to have people taking more money out as they go on their long vacation. Now, when we look at the vacations, they're expected to be up about 10% from last year, obviously with what happened last year. But they're still going to be about 30 to 40% below 2019, just using 2019 as the baseline before obviously the COVID, wreaked havoc. So there's going to be that structural shift. Now, how do we compare that to what's going to happen with oil demand? Well, when we look at oil demand, you had a lot of guys, especially the refiners, the independents, they used up all of their import quotas. So December came down. We're going to have a little bit of a makeup number in January, but it's still going to be down from where we were in November, which is a concern as you start to see some of that slowdown in movements, just given the COVID restrictions that have been pushed throughout all of China.
Now, the Fed's Kaplan, if we move to the United States, talked about, he mentioned the word rates today and sort of alluded to and there's a lot of debate with all the liquidity, and we're going to talk GameStop because you have to talk GameStop, not in terms of the stock itself, but in terms of the liquidity crisis and what happened over the weekend with capital raisings and the functioning of the market. But Kaplan kind of talked about raising interest rates. How do you balance where the Fed is at right now with the numbers that you're seeing with coronavirus cases, with vaccinations? How does it all tie to you, and what are you watching?
Well, I think Powell is going to have a little sit down with Kaplan, and he's going to have to restrike what he said or clarify it in some way, because it was a bit more along the lines of, I think, how most financial professionals are looking at it, where like, well, why aren't rates starting to go up if we're starting to see things get a little bit better? Not to say that they're going to explode to 2%, but at what point do you start to see that those moves higher? So when you're looking at what Kaplan is saying and what he's seeing in the market, it's that you have that liquidity coming in, but you also are starting to see some of that pressure to the upside as rates start to creep higher. As guys are pricing in a bit more inflation, that is starting, the break evens are going higher and higher. So you're going to see kind of that natural pull up of rates. Not to say that you're going to see them go from, to 0.25% all the way up to 1%, but in terms of what is naturally moving within the market in general, Now, what we're looking at the most is always going to be, what is that 5-year break even? What does the 5-year versus the 30-year look like? And then are we starting to see some bear steepening, some bull steepening? What is happening in the rates market? Because when we're looking at bonds, bonds are inverse to interest rates. So you want to look at bond pricing, I should say, is inverse to interest rates. So you want to look at what is happening with the yield. Is the yield getting pushed up? That means that prices are starting to fall. It means that guys are looking to sell. So when you're looking at liquidity, they're continuing to be very concerned about, is there too much liquidity in the market? Answer is obviously yes, but it's not getting to the market in general. It's still locked within a very tight confines of the bank's balance sheet and the Fed balance sheet, and they just keep going back and forth with not as much really getting pushed into the market in general, and just being used for financing terms on loans, mortgages, all these other things that they're trying to get to the general populace.
So what changes that? I mean, you're talking about the markets are moving interest rates, the Feds are responding, but generally in terms of the policy raising it, do you think that we'll see a raise at the end of this year?
No, I think that there would have to be some existential change that is gonna drive their shift to see this happen in 2021. I think it's fair to think that they're going to try to do something a bit more gradual in the end of 2022. Obviously everything can shift. The Fed has proven to be very reactionary, not proactive in terms of their movements. So I think if they started to do something at the end of this year, that would be a bit more of a proactive move, and I think it would be welcomed by some of the market participants. There might be that taper tantrum that we've seen multiple times, which is the conundrum that we're getting ourselves into in terms of giving these drugs to the junkies and just increasing the amount. What happens when you start to take it away and try to get into a normalized market? That's when you start to see some of these friction points. Now, going from 25 basis points to 50, should that be a huge deal? No, because it's already going to be priced in. But they're only going to respond to what is priced into the market because they do not want to shock it at this point.
So I think we have to talk about GameStop. And I want to talk about GameStop not as the stock, but in terms of the risk and what we saw over the weekend with liquidity and Robinhood. How close, when I think back to 2008 and I think about the Secretary Paulson meetings and sort of like the fact that we were days away from a collapse of a financial system. And it seems kind of crazy, but the hedge funds were down $20 billion mark to market. GameStop had gone from $20 a share to north of $300 a share. The short interest was in excess of 100%. Robinhood kept having to raise money. They talked about raising $1 billion from banks on Monday. And there seemed to be a real concern over the weekend that Robinhood was in danger. Mm-hmm. I'm curious what your view was on that. And is this now past with GameStop going back into the hundreds, or is this a risk that's just going to roll through the market that the Fed's paying a lot of attention to?
It's going to come down to balance sheets, and Robinhood was terrible at managing his balance sheet before GameStop became a thing. And so you have to think about what is happening at the balance sheet level, because you have to have a certain amount of collateral that you can post, which has to be in some sort of liquid asset, whether that be cash, T-bills. So when you're looking at the cash cushion that you need, you have to think about, okay, well, how does a normal trade work? And I started my career in middle office operations, never thought that would be so important until something like this happens, where when you're in middle office operations, you're making sure that stocks are clearing, that the stock is settled, that if you lent it out, and by lending, which means that I'm going to hold this for a long period of time, so I'm going to lend it to the short seller who's going to turn around and sell it. They're going to pay me a rate in order to fill that void. So what happens with GameStop? Well, GameStop saw twice its float trade in a day. Now, even though the cash value in an account will go up and down within seconds of the transaction, the stock isn't actually settling for T+2. So now that you have so much stock churning, you're showing people a cash value that doesn't actually exist on the back end. So that means you're posting a certain amount of collateral. Now, if as people start to draw down on that collateral on the back end, you're going to have a balance sheet getting stressed. So if the balance sheet of the company, so let's use Robinhood for an example, They have to work with the clearing broker to make sure that they have enough posted collateral, and then that's going to whittle down to, as you were talking about, with the prime brokers, because now the prime brokers are going to say, look, you're short collateral, you need to post collateral by the end of today. Usually, depending on the stress in the system, by about 1 to 2 p.m., you're going to have collateral calls, and you're going to have until 4 p.m. to make that call, which is when Melvin went out and had to get cash. They had to raise about $2.4 billion to post that margin, that collateral against what their positions were. So let's look at the typical structure within GameStop and what happened within Robinhood, because everyone's like, oh, it was a coordinated attack against the little guy. It's like, no, the stock was so gunked up in the system that you had clearing brokers essentially pulling the ability of actually trading that stock. Robinhood was hit first because they had the worst balance sheet, and then others started to whittle down until they could transact, they could transition the stock, make sure that everything was okay, and then reopen it. It just so happened that it was moving back and forth between a very finite group of individuals that we saw that strife within the system. Now, layer in options and the fact that we were coming into month end, you had option expiry, you had a lot of stocks starting to cross. I mean, there was a lot of things happening at one time that created a slowdown in the system in general. When we think about what happened in '08, '08 was more, Lehman was having a problem with total return swaps, interest rate swaps, and swaps that were measured in hundreds of millions of notional, versus when we're thinking about, I should say hundreds of billions, when we were thinking about tens of billions. So in terms of the structural issue in the system, it wasn't really widespread, where it was very much directed at a handful of stocks that were transacting versus across very weak companies.
So it seems like that crisis is past, so everything is on. I know you and I have also talked about commodities that you like, and one of the ones you like is silver. So it was interesting that silver was mentioned on the weekend. Seemed like a bit of a bait and switch. I wasn't totally clear how you could move the silver market, and I think the Hunt brothers discovered that it's very, very difficult to do. So we saw a very quick move up 10%, down 10%, and everything's back to normal. Any fallout that will come in the market from this go forward, or changes in your expectation for silver? Why did they pick silver?
I think it was more of a structural thing, because depending on who was talking about it, some people were pushing it, others were saying that it was people trolling and it wasn't real. I think that the silver push was a bit more of a structural move. And you have to think about silver is a commodity. So if anybody's going to try to make a run at silver, the actual producers and then the guys who buy the physical would just say, okay, I'm just going to push more physical into the market. And then all of a sudden you get this move lower. Silver and gold are still going to move against the dollar. They're still going to move in tandem in terms of some of the data that's out there. Silver does have industrial usage. So as, the industrial side gets a little bit better, but then you have China, which is slowing down a bit. Silver is going to have a lot of dynamics behind it outside of just some guys think that they're going to create a short squeeze. It's just not going to happen. The silver market's too big. You can push it up. You can maybe get the ETF going, but then the ETF will immediately push back on you. So it's hard to really see that move. I still think silver is a structurally good trade, just in terms of some of the backdrops that we've seen. Its inherent spread between gold, where things are going on an industrial level, especially when we think about car manufacturing and how that's picked up. So there's some benefits to the silver market. It's going to be very noisy and volatile, which, what commodity isn't?
There you go. All of this will be discussed on the full videos that will be being released by Primary Vision and Mark Rossano this week. For that, check the links, follow them on YouTube. Anything else you want to talk about that you're thinking about into next week that really has you either concerned or excited?
Some of the things that we're going to dig into a bit more is going to be PMI on a global level. What is trade doing, just because trade is so important in terms of pricing. And we're going to start to really dig further into some of the grains complex, just because China is a very interesting dynamic with where are grains going right now. Who's short, who's long, Where is that going to go over the longer term as we see prices continue to push up? And there's been a lot of political strife that's only increased over the last few, let's call it the last few days, really, now that we've gotten some back and forth between the Biden administration and the Chinese CCP. So there's definitely a lot to talk about on a political level, especially as we see things with Burma or Myanmar. And then what does that mean, and how is that linked back to China and some of the narratives that we've been talking about with a lot of the problems with Hong Kong, Taiwan, Xinjiang, with Tibet. Where is this going to go? How are we going to continue to try to work together? And as we've been saying, the bridge that is building this gap continues to widen, and we're just on borrowed time.
Well, I think everyone learned this week that in Myanmar, even if you go in and take control of the leader with guns, that may not be a coup, but a guy in a Viking hat sitting in a chair definitely is a coup. Until next time, I am David Ramsden-Wood. I'm with Mark Rossano for Primary Vision and Hot Take of the Day. Thanks for joining us on the pregame show, and we'll see you next week. Bye for now.
Bye.